Welcome back, episode 57 of the Ground Up podcast. You might be self-employed, normal 9 to 5, an employee, a worker, or you want to get into property or start and establish a proper business. Then we're going to hash through that.
I like to think about where do you create value in the market space. That could be a service, that could be a product, that could be a skill, that could be knowledge, that could be anything.
What do you want? Rightly or wrongly, I want to dominate the world.
Dee's going to run us through a debt fund.
I think the biggest problem with setting up and growing an equity fund, the capital raising.
A development training academy purely to teach people to find great deals that match the criteria already set out by the equity fund.
It's what we call it.
Ground Up fund, baby.
Ground up capital. We could be like the Y Combinator.
I thought he was going to say the Wild West.
I live in the Wild West, so it doesn't scare me.
Ground up sound, ooh, yeah. Real estate deals. We lay them down, let's get those deals. Deals, deals, making money, baby.
Welcome back, episode 57 of the Ground Up podcast. We're recording this one on a Sunday, which is a bit weird for us. A few days after the last podcast recording that went out, because we all got a bit of a stacked week. So we should hopefully get another one done this week. So we're a week in hand. But today we're going to talk a bit ad hocly about the transition from being, normal 9 to 5, an employee, a worker, or you might be self-employed, but you want to get into property or start and establish a proper business. Then we're going to hash through that and just talk about our journeys, as much advice as we can, mistakes to look out for, all that kind of stuff to be as useful as possible, whether you want to transition to being a developer or running a business. We've all been through it multiple times. So we feel like we could offer some useful nuggets here. We were going to touch on it in the last episode, if you watched the last episode, but we rambled on about other shit. So we didn't get around to it. We will do it today. We're also going to talk about a load of other bits that lead on from that, like technology to employ and all that other kind of stuff. And Dee's going to run us through a debt fund that he's currently looking at as well. Stuart may join us soon. We're not sure where he is, but he should be jumping on. And if you're new to the podcast, number one, thank you very much for watching and tuning in. Make sure you subscribe and share this with other people. If you don't know who we are, we're 4 property developers from the UK. We all run multiple businesses. We're doing about $250 million in development pipeline. And every week we talk about property, business, how we're getting on, and try to be as useful as possible. You've got Jack Jiggins, Dorian Payne, Stuart Wyeth, and myself, Ryan Beaumont. So enjoy. Big love. Let's get in. Dee, do you want to lead us with this debt fund strategy you're talking about?
Yeah, sure. Good morning, all. So as you know, we raise lots of money and we are very ambitious and looking to raise lots more money to part refinance some money we already have, give us some more money, reduce the cost of debt, and basically allow us to keep growing and scaling. I'm confident, just like you two here, that we talked about this in the last podcast. Really, the one big missing link all the time when you've got your strategy and our ambition levels is just the right capital. The right capital from the right funder at the right terms becomes that missing key. And if we can unlock that, the world's our oyster. So I've been fundraising like properly on larger scale for a little while now, and I've just pulled up an old spreadsheet I got, which actually, Jack, I'll probably send this to you in case it helps. Still, there's 300 lines in here of different funders and funding people and family offices and venture private equity anyway, there's 300, right? Some of which we've been speaking to, some of which didn't respond, all that sort of stuff. So there's a lot of work that's gone into that. And the one deal I'm doing with now, which I've referenced before, about like this partnership with a social impact fund, and they'll fund all of our pipeline and can really help us scale. Funnily enough, isn't even in in the list of this 300. So the first lesson out there is that there's so many different funders out there. It's like you just never know who that one yes is going to come from. And I think as a business owner, we just got to constantly be canvassing for that information. The second one is that I'm currently speaking with a debt fund now that I was speaking to the investment director of on Friday. And that introduction came through a connection which I met at my membership of Business Leader, and I went to one of their mastermind sessions, and a guy was there who did scaled and sold a business and was scaling via mergers and acquisitions. And I told him my story. He's like, "Oh, I need to introduce you to this debt fund. They're really entrepreneurial. And when he told me the name, I was like, oh, I'm sure I've spoken to them or even tried reaching out to them. Anyway, I looked at my old spreadsheet, and they were the one of them that hadn't responded. Obviously, I was trying to get to them through cold outreach and didn't respond. Within one email of an introduction to the investment director, a call was set up pretty much straight away. And anyway, I spoke to them, and they're really, really impressive and interesting. And I told them what we do and everything, and seemed really intrigued by it and interested, but obviously it's all subject to the finer details. So I've been putting together an investment pack for them. But I suppose the lesson in that is that once you get the list of um, kind of investment leads to go to, whether it's a fund or family office or individual, if you can't get through them through cold outreach, then trying to get a direct introduction from them is, whilst it's easier said than done, does a call, just because they're not responding to the cold outreach doesn't mean that they're not actually interested. They just obviously have so many cold outreaches coming through that they probably only prioritize or deal with, if they're established, referred leads. Because as even as land developers, we know a deal coming through that's referred, like through an introducer, agent of market, we're going to spend most of our efforts on that rather than looking at kind of the cold leads. Does that make sense? So I'm just sharing a couple of lessons here as they've been coming up again, just for those listening. And anyway, long story short, spoke to them, and yeah, great. Did you want me to put an investment pack together? So I just thought what I would do, because Jack, I know you're experienced in this, and I know yourself, Ryan, as well, and obviously your dad's has experience in raising funds and stuff in overseas. But in terms of when I put together a debt or like an investment memorandum for a fund or for what an investor even, what it looks like in terms of the wait there, the reason why I can't fucking open it. 1 second.
So while you do that, we've got the exact same thing where we've got Excel lists of private investors. We've got Excel lists of institutional or what I call corporate investors. So official entities, family offices, funds, and then we've got a list of mezz lenders. Then we've got a list of direct debt lenders that we work with. So we've got like 4 different lists. We probably spend most of our time on private investment at the moment. We did shake the trees of the corporate and institutional funding, but then kind of more reverted back to private investment because we actually kept going to meetings and they say, we expect that you put in all the money. We pretty much put in nothing, but we bring the deal, the expertise, the time, the sweat, the blood and tears, and the delivery. And we're happy to take an element of risk on that. So guarantee, the debt piece on it particularly. And then we split the deal 50-50. And they'd always laugh and go, you're not going to get that in this room. It's 80-20 in our favor, and you've got to hit a hurdle.
Yeah, so promote structure. And I think you're right, especially on these ladder deals and development deals as well. I had those exact same conversations. This deal this is a debt fund for working capital for a trading business, not for development. I should have made that clear. But in terms of structure, so I have like, the what I want to include in it, and this is just to shoot it with you guys, see what you think as well. So obviously I have the cover page, I have just ourselves, and the executive summary of what the pack's going to be about, like who we are, headline stats, the business model, the investment required, the introduction to the Castas Group, who it is, who we are, what we do, what our mission is, and who we serve, why we exist, what the problem is in the marketplace, obviously the housing crisis, etc., with details and the amount of money being supported and the clients we work with. Our history, so just from start to finish, where we've come from to where we are now. History about me as a founder, because it is a key bit of information. Then I go into that's the introductions done. Then I go into the business model itself from start to finish, as clean as possible on one slide. Client led, forward, get the criteria, find the land, forward sell it, do all the planning stuff, etc. Sell it, make a land uplift, get a build contract, be on a positive working capital cycle, all that. I show them a typical deal time frame of how that happens, and a typical cash flow of a deal to show that goes into the red before it comes into the green, and that happens over like 2 and a bit years. Then a bit of a dashboard with our key KPIs, so our size of our pipeline, the number of homes we've delivered, the number of homes on site, the amount of money we've invested into the community, and the total number from percentage of the clients we're working with versus the clients out there, so like our client reach, call it, and some client feedback. Then a map of Wales about where we're operating across Wales with our current completed and upcoming sites. Then a map of the entire UK with the different regions identified of where we want to scale to, show that big picture thinking. Then a slide on like our management team, just to show our capability, our values, and then it goes into the numbers. So the growth strategies, the financial forecast with one scenario and another scenario, as a graph on our pipeline certainty. So we know, as I speak today, with our pipeline, that for example, financial year end 26 or March 26, 100% of that's either on site or in our pipeline secured. Financial year 27, 100% of that is either on site or in our pipeline secured. Financial year end 28, 90% of that is either on site or under our control. 10% is from estimated sites we do not yet currently have. And then financial year 29, 60% is either legally under our control, like exchanged, or currently in legals, and 40% is unidentified. So we're just estimating there. Obviously, we've got a few years to get them. Then a snapshot of all our historic accounts, and then the narrative to go behind that. Like, our overheads are really high because we've been gearing up to be a 50 million plus turnover company, whereas, so they're higher than they should be for the years. A bit of graphs to show financial trends, cap table, org structure for the actual companies sit behind it, the key risks we've encountered, so inflation, planning, buyer risk, delivery, working capital, and grant funding, and how we're trying to mitigate them. And then finally, then into our current debt position, the investment required, and what it's going to be used for specifically, and then the positive impact day one that would have on the business, and then the future impact. What would you normally have in a pack like that?
To be honest, it sounds like you've covered everything off, mate. I think the issue seems to be more what do they want in terms of what are the terms, and you being able to facilitate terms that work for them, rather than them feeling confident in you. Because I think it's easy for them to feel confident in you because you can put all this stuff together. You can show your due diligence, you can show your expertise, the astute management team you've got. All those things will tick all their boxes. But if the terms aren't right, just because the nature of the kind of people that you may be going to for it, for debt funders, if they're just going to kind of go, well, look, this just isn't the way we do business because we've got all these other options in a wide marketplace of potential debt funding where there's potential for higher upside. Why would I go with you?
And I think that's definitely important to consider when canvassing and on the first meeting. Obviously, that was all raised in the first meeting. So their terms, they are a debt growth lender. So they provide just pure debt for a period of term. You service the debt interest only, and the capital repayment is on the end of the maturity date. They take the security is based on basically it's calculated on affordability. So how can you afford it? And they will take into account adjusted EBITDA for that and also forecast. They don't dilute the shares in terms of wanting an equity stake, but they do. But on the other hand, though, they say they do require a minority equity, piece for providing the debt, and they're talking though in the region of like 1 or 2 or 3%, just so they can be a bit more shareholder aligned. And then yeah, that's how it works. And then the cost of it is at the mobile base plus 7 or 8%.
Is there any way you could, and I'm spitballing shit here, but is there any way, like if I was this debt funder and I want to deploy lots of capital, and I want these terms to nurture into a larger working relationship, and I can see you've got these ambitions to grow, but anyone, and I know for you it's real and you're going to fucking do it, and I believe you're going to do it, but anyone looking at you is going to go, well, everyone's got dreams to grow, Dorian. So is there a way you could have kind of, and I know it'd be a lot of DD and you'd have to, do all the work to get this done. But if you had a clear strategy where you had, here's 4 or 5 partnership agreements we already have in place for different regions, companies, we have terms where we can acquire them, merge them, serious growth already in partnership. We just need the debt. And then we can 4 or 5x the business over the next 2 years because we can then use your capital to deploy that in, integrate all our new systems, take on their land, start operating in those areas. But they're not just like, here say we want to go into this region. It's we've got XYZ company, someone lands and construction that we've already got a partnership agreement with them. We're going to be going into business with them. and we can take them over if we have the capital to buy them out or to forward fund, XYZ amount of pipeline to then take over the company inadvertently, and kind of dilute them out. Is something like that not going to be more appetizing for the kind of guys you're bringing on, so they can see a definitive roadmap for growth rather than just we're going to expand? It's more we've already got interests in different regions, and all we need is the capital to just go, cool, start a new region, start a new region, start a new region.
So they definitely support and fund and help fund mergers and acquisitions, which would be the approach to do that rather than just the pipeline. It'd have to be acquiring a company in that region, and I think it's really what I definitely agree with you is it comes back down to this chicken and egg situation. I don't. The resource required to go and get those partnership deals as you're talking about, or even leads or opportunities that are actually real, is actually a significant investment to do that. I wouldn't want to spend the time try. If they turn around and said, "Look, we won't fund you now, but if you go and find like the next piece and you need that funded, because it's that case that we'll get involved in that piece." What I'm trying to do now is say, look, I've built this region to where it is, and obviously with the pipeline certainty of where it is, you've got the next 3 years runway already set out. We've already done that work. So base the lending off us now, and we will go and replicate what we've done over there, and then build that up, and then obviously do the same thing. But if they don't want to do that, and they're like, no, we don't want to do that, but if you find the next one, then we'll definitely be interested. Then it gives you still need to then be comfortable enough from the business point of view where we're at today. Do we have enough resource to go and spend that speculatively on finding that next, deal to merge into that region? It becomes riskier in the short term because we're funding, all that we could find that deal and then they could turn around and still say no for a different reason. But yeah, I mean, I do agree with you. It's definitely that would 100% be approach. It's kind of how I secured funding in the first place for this business. I already went and secured the pipeline of deals, and then I went to an ultra net worth and was like, look, I've got these hundreds of homes here to build. I've got HA contracts with all of them or agreed offers. I just need the working capital now to get these over the line, and boom, that's how it happened.
That's where it's less chicken and egg, right? Where, you just need, you had to put in, we all have to do this anyway. You have to put in some element of risk capital to establish like the next step. And then you bring an investor in or a debt funder in, or you raise the finance. It's kind of like doing a project, isn't it? Your soft cost is your risk capital, and then you can like deploy. So maybe that's something you need to discuss with your existing shareholder, existing family office, and go, look, there's a potential here. If we allocate XYZ amount of the next year's profits to establishing some kind of framework agreement or partnership agreement with the next region where we see the most upside. And once we've put in, say, 300, 700 grand, whatever it is, we then have more viability to raise this debt funding, to buy it out, get the capital back, and scale the next region, the next division, or however you're going to operate that with the head office, or just completely separate regions, or maybe that's just the answers. You have to put in the risk capital to get these guys over the line, which is pretty standard, isn't it?
Yeah, I mean the terminology proof of concept is really important for any backer. They want to see that you've built an aircraft and got it off the ground and flown it as far as it needs to go to prove that you can do it before you go into manufacturing the scalable business model. I mean, Dorian, it sounds like you've covered everything off. One thing that I would say to listeners from a investment perspective is if you're approaching someone that's going to bankroll the whole business model, yes, you will need to go into that much detail. But the question is, do you go into that much detail just to get a face-to-face? Potentially not. And I would always say that you don't ever want to give the investor all the information before you've met with them face-to-face, because they will talk themselves out of it and pick holes in it. But if you can tell them the story to their face, they get to meet you, they understand the vision, and there's that more personal aspect, then that's the best way to lead in. So our investor memorandum decks for deal by deal is no more than 4 pages. It gives them enough information to go, yep, I could fund that. I've got that amount of money. I like the duration. I like the location. Let's have a further conversation, because we've actually found if you give them too much information, they just turn around and say no, and you don't know why. They've talked themselves out of it. So we try and keep it limited until we get a face-to-face. Then when we've had a face-to-face and they say, we need to see the information and the data on this, you then go, bang, here you go. So we typically start with a rough proposal on the first page so that they can almost see what they're reading about, so it gives it context. So we typically say ticket size, duration, what we're expecting to do. Then they know, right, the rest of this report or deck is giving me a bit more of an understanding about it. But I think it's really important to try and get a face-to-face first without then sending, because we've sent investors that we know, like, and trust our actual Excel. Now I don't need to like pre-qualify them and get them on board of the journey. I just send them the Excel. They go, yep, cool, makes sense, let's go. Whereas that takes time to get to that point.
No, I agree. Yeah, and just for the listeners, I've already gone past checkpoint 1, and I would agree with you. I would never send or go into this deep level of detail from a cold start, because it would just thing. But only after having that kind of this was a virtual face-to-face Teams, because obviously they're based in Ireland and I didn't fly out there. It's we spent a good hour just going through the high level side of the model and everything, and then lots of questions came from that. See, from very experienced individual, the investment director, 2 decades of experience, so loads of questions came from it. And then following that, the request for a detailed deck of information. That's where I'm at now. So that's I would agree. I think on our cold ones, it's very much say you want to give the sizzle and be like, you interested in this bad boy? Thanks both, by the way. Thanks.
My turn now. I'm going to throw something at both of you guys, see what you think. Because they just sort of inspired some more things that we're looking at as well. So just for a little bit of background for our viewers, my dad, before we got into property, he managed funds, started funds, all those kind of things in the private equity space, in the sort of offshore space, pension funds, all those sorts of things. And we then came into property, and we saw a way to actually provide really good products for investors in that world of finance. There's a lot of management fees, there's a lot of fees get ripped out left, right, and center, and ultimately a lot of it's done through pensions and things like that, where the money's got to be allocated anyway. So it's a bit of a fucking fugazi of an industry, whereas property is real, it's tangible, it's asset backed. There's first charges involved, there's SPVs involved, there's clear structures of ownership. And we just thought that was a much better business. But we knew that to scale this long term, we had to build some kind of fund structure. And we maybe got way ahead of ourselves in the first few years, because we thought it'd be easy enough to do. That Dad set up funds before for worse products, and we've got a great product now. But the issue is regulation. The financial regulation in this country is insane, especially if you want to raise an equity fund. You end up looking at something like a REIT, which just requires a ridiculous amount of startup capital, capital to run the fund. You need FCA compliance, someone on the board who's got the FCA accreditations, or FSA, however you want to call it nowadays. And we just saw this as a whole load of regulatory burdens. We looked at offshore bond structures as well, all kinds of things to try and create an equity fund. Really, really, really difficult. You need scale like a motherfucker. You need like serious scale to make it work. Like deploying hundreds of millions a year is what we, 100+ million a year is where it starts to be really worth it. And then you want large transaction sizes as well. So you want really good partnerships with developers who can deploy 10, 20 million at a time. And all those sorts of things. And all of us guys have explored these options before, and I'm sure come to the same conclusion. So what we are thinking about doing, something that I think is much more tangible, is setting up a bridging company. Because what we've done so far to date is create an ecosystem end to end for ourselves and for investors as a service model, where we do the acquisitions, the design. We've brought on 2 new non-execs now who have architectural practices and digital surveying company as well. That's at good scale, and they just feed in nicely into everything else we're doing with the construction, 2 construction businesses, and then we've got the lettings and management and the maintenance division. We cover all the operational parts. We've got third-party framework agreements with our brokers, insurers, accountant, all that kind of stuff. So it's a plug-and-play model. But we still, on certain sites, have to go for fucking development finance and bridging finance, which plays 2 sort of things. One, it leverages equity capital that our investors have and that we have, so we could do more, go further. That obviously inadvertently helps the revenue amounts in our trading vehicles. So it's kind of like it's a net benefit to us to leverage, as long as it's sensible. The issue is that it's just it's so expensive, and it's so much effort, and you're constantly going through different banks because you don't want to be leveraged up with the same bank. on all these different schemes. So there's just a whole load of complications that get involved. So we're thinking of setting up, or we will inevitably set up a bridging company. We'll do it in offshore, and that bridging company will be financed somewhat through our own money over time. And then we want to introduce a high net worth investor, someone who can put in 10 million, someone who can kickstart it, accepts the first couple of years of distribution where we're not going to be able to utilize all the funds day one. So there's a ramp up period, all those kind of things. And then that services our ecosystem. And then we can leverage more business out of the equity from us and investors, and it's secure within our control. And obviously we can mandate whatever we want. It's not sort of an unregulated space. Still take the first charge positions and all that kind of stuff, but it gives us a load more scale and cheaper access to finance while still being able to make good money from that bridging arm, and then potentially offering that out to third-party developers as well that we know, like, and trust. And I say it may be that this plays long-term into the ground-up ecosystem and what we're kind of building here anyway. I think it's something inevitable we're going to do just because we're sick and tired of going through development finance and the ball ache that comes with it. It's probably a 2-year roadmap until we'd implement something like this. But we know that it's viable and it's something we can do. Obviously, there's a whole load of caveats here. What do you guys think in principle, and what do you think the issues are?
We've thought about this as well. In actual fact, an underwriter of a bridging lender that we worked with a lot, basically, his credit line changed and his cost of capital went up, and he basically sort of slowly rolled the company into a sort of nothing essentially. And has since then has always been desired to set up a bridging lender again. I think there's a massive opportunity and massive space for a stretch senior lender that's good, like a pragmatic stretch senior. So stretch senior, for listeners out there, is where you're gearing up a little bit higher than the regular bank. So maybe 65, 70% loan to GDV, but you're pushing it a little bit higher, maybe 85, 90% loan to cost, because it stretches your investment further so you can do more deals. They're still not taking relevant risks because they're still sat below the equity position. Obviously, there's more risk than if they were low loan to value. There's still not relative risk. And it also enables developers to get cracking and build a good relationship. And at the moment, there isn't a single debt lender out there that I'm like, their process is really good. I really enjoy working with them. They're very pragmatic and relationship driven. They look at something and try and fix it rather than trying to break it. So I think there's a huge space for a senior stretch lender that does it really well. There are a few parties out there, like Paul Oberschneider's got Hilltop Credit Partners. They will leverage it up, but they really charge through the nose. You're looking at like 14, 15% return, cost of capital for the whole rate. Whereas if you went with like a UTB and a mezz lender, you'll probably get it cheaper than that, blending across the facility. So we've looked at it, and the reason I say that is because this underwriter that's now not, he's still in the debt markets, but he's almost got a facility over the line. And he was kind of like pushing me to call it XB Capital, and he gets rolling with it. The reason why I'm not that excited about it is because I think it's quite a operationally and recruitment heavy business, working in the debt space. You need a lot of people in the team. I think you need to hit a critical mass of like circa 50-60 million pound book. So therefore you need a big team. And I don't think you're basically making a clip on capital. So I prefer exponential growth businesses where the bigger you grow, the better your margin gets. Whereas I feel that the clip on a bridging lending company is very predictable. If you've got a 60 million pound book and you're getting that out and you're bringing it in, let's say you've got a facility from Shawbrook at 8% flat, and there's non-utilization fees of that position. You've then got to get new business in. You've got to have business development managers getting funds out in the market, and then you've got to have team delivering it in the market. And you're then going to be making a clip on that, maybe like 2 or 3% on the capital. So it's very predictable what your profit margin is going to be managing that fund. Whereas I like exponential value businesses. And the only way that you can become an exponential value business in running a bridging lender is if you sell the company. So you sell the company for a multiplier of its EBITDA or margin.
What do you think of an equity fund, Jack?
That's different. I would, yeah. So the better way to fund it, I think, is have a smaller book, be an equity fund. Obviously, you're riding a lot more risk. I think if you run an equity fund, you've got to have the capabilities to finish sites off, because often you may have to step in if a developer is not necessarily, is at least not necessarily finished off the scheme. And then if you're on something like a hurdle, like 20% coupon plus, and or 50% of the profits, whichever is greater, that would be a great business to run. Again, you do need quite a big team, probably not as big, because you originate deals very differently. You have a very different level of credit. You obviously need, as I mentioned, the sort of step-in rights and capabilities of delivery, because that is if you're doing 50 deals a year, you will have to take on 5, and that's just the reality of it.
We should definitely do an equity fund. I definitely think there's a gap in the market for people who genuinely have the capability to run deals. They're best placed, right, as you said, to do equity deals. And should they then get through underwriting, statistically they should have a better chance of being okay. And then if they are, then great. There is upside, and that can scale exponentially. And if it doesn't go well, then, as you said, there's capability there where you should be able to bring it home. With that, hopefully not though, because that there's not really going to be much money in doing that. It'll just get the capital back in.
I think the biggest problem with setting up and growing an equity fund is the capital raising, is getting the actual, where do you get the money from? Where does your credit line come from? Realistically, think you should be starting at 30 mil. I think we've obviously got the benefit that we don't necessarily, it's not our bread and butter. If you left, let's say for example, you left Shawbrook Bank and you're like, right, I want to run an equity fund. You haven't got the benefit like we do, where we can lean on our existing businesses to get things off the ground. And that's exactly how equity surveys work. Like, I could probably get 30 out the door without even having a business development manager or someone in sales, which is the benefit we have. So we could probably start a bit smaller than others, but probably 30 mil to start. I do think the difficulty will be, capital raising, because when you look at, so for an example, one of our investors who invests in us directly has 3 pots that he invests. He invests in buy-to-let properties, he invests in bridging companies, where he gets about 10% on his money, and then he invests with us. We're like the wild card. The problem with property equity investment is 100% your book is wild card. There's no 10% sat at 70% LTV. It's the risky slice, and you've got to have really good risk appetite for that. And typically, a lot of investors have diversification across those portfolios. They'll have a secure pot, a medium pot, and a risky pot. That risky pot, it tends to be discretionary finance. So it tends to be maybe their own money that they've spun off on profits. And it tends to be not capital that they're borrowing off someone else, because there's a rod in their back for that capital, where they have thresholds and LTVs and conditions that they can't get their money out the door. So it's got to be someone that's enterprising and open to higher risk, higher returns, essentially.
I don't think there's a shortage of those investors. I think it's just having a compelling pitch, which is where I think an equity fund would only, like, if I was thinking from Beaumont and Partners perspective, a bridging fund we could do on our own, because we could we've got a pipeline. We don't need to raise a great deal initially. That same reason you sort of explained with XP to XP surveys. We've got the same thing there. We have a pipeline. We're going to go for development finance anyway. We just rather do it internally. But an equity fund, just not appetizing enough for us on our own. At the scale we're at. Longer term, sure, maybe. But the second you put 4 developers together, plus, how many other people do we know that we would trust who could also sort of participate in terms of deploying capital? Suddenly, you go to an investor and go, look, between us, there's probably over 100 million that we could deploy over the next 2-3 years from a standing start. Established businesses, they've got all of the teams and infrastructure and everything in place. You're not really taking a gamble. It's more the markets, really. I think that's going to be the debate with an investor. What do they think of where the markets are going? I actually don't think the concept would be too tricky to convince someone of, as long as there's a good management team that's going to look after that fund. That's where they'll look at us and go, have you managed a fund before? Well, no, we haven't, but we've got this guy from Shawbrook or this guy from here, he's X whatever, and he's going to manage it. Then I think if that's in place with a great concept, and a clear runway to deploy a ton of capital with the upside we've already proven with the legacy of our existing businesses, I think it's a pretty straightforward pitch. It's just sitting down in front of 100 odd investors and getting one to say yes.
It's kind of like the deal I'm doing at the moment with the social impact fund. Obviously, they're investing in what would traditionally be the equity slice of a development. They're providing the capital for us to exchange on deals, acquire sites without planning, to fund the planning, to fund the soft cost and the design stuff, which typically is from a developer's point of view where all of the equity contribution goes to. Like you have to fund that most riskiest bit, and then the development finance players come in. And it's so interesting when I was having conversations with the chief exec, the chief investment officer, and they're obviously from a traditional fund mindset where the reason why they don't go out willy-nilly to just try to raise an equity fund on us, even though it has from the like the social return on capital, the impact on capital is significantly higher than anything they can do just with their standard investments. But obviously, it requires knowing, and it comes across in the means, it requires knowing so much of the granular detail that they just would not be able to get across to where their funding lines come from. That they would do safe. And really, even though we're talking about a decent investment level with us, 10, 20 plus million, as a percentage of their overall fund, it's actually well, really small, single digits. So in they can take a risky thing like that with us, and it's still, as Jack said, like diversified and controlled. Well, really diversified and controlled. And the vast majority of the stuff is in stabilized, maturing assets, pumping up, you know, uh, inflation-linked yields. So, but I think though, I definitely think I've been thinking about this a lot. There is a significant gap for a proper all-rounded company that helps bring in new developers. We're talking about the training stuff now. Whilst I'm not a big fan of the sector, but you need a combination of new people coming through as well as working with experienced people, being trained properly to find good opportunities, partnering them with obviously experienced contractors in their thing, overseen by an employer's agent that makes sure that all contracts done properly and the costs done properly. And there's an equity fund sat behind it all that actually deals that go through a rigorous checked process through underwriting and with trusted third parties, like I said, EAs, doing the tender and stuff. Then it's like there's huge scope to scale that massively and get the upside of exponential returns, and also scale a cash flow and business model.
What do you think the internal team needs to look like for something like that? Because I know you said, Jack, that you need quite a sizable team, but bar legals and monitoring, which you could outsource quite easily, what would that internal team need to look like?
For like a £50 million book, you need 3 people in sales that are kind of manage. I personally think that any good lender, the originator sits through loan all the way through, and it doesn't get handed over to a credit monitoring process because they've originated the deal. They understand the nuances with the deal and where the limitations are with the project. And then they also come through the drawdown process with you. So if you look at like a lender like UTB, the person that underwrites the deal at the beginning as an originator is the person that's dealing with the drawdowns and refi and tail end, which I think is the best way to go because you build that relationship with the one person, they carry it all the way through. So you'll need sales/originators who then liaise with credit. Credit is typically the board, so whoever's managing the fund. So that would technically be if we were setting up our own, us 3, and then you'd probably have 2 employees that would do more data finding and finding risks. So they would present a case to credit. So if you look at Shanley Holmes, for an example, he's the final credit. Like Mr. Shanley, he signs off every deal himself. You'd then need people in finance and accounts for financial modeling, accounts management, and bookkeeping. You'd then need a few admin people to pull it all together. You'd need a marketing person, at least one. I would recommend that marketing person has a good contacts with sort of videography and producing the digital media of what the business is doing. And then I don't think you need too many more, but I mean, that team, you're probably talking about 10 heads, I would say, to manage a £50 million fund. And there's a few other things that you can outsource, like monitoring, surveying, and obviously valuations. And then you would then be reviewing those as the credit would review valuations as they go through. But the key roles are credit, and origination. And other than that, it's mostly administration roles.
So I reckon, right, like I said, it comes back down to this. I just chat GPT'd what my thoughts were to make it more, come out more professionalized. A vertically integrated property development ecosystem powered by an equity fund. Oh, step one, we develop a development training academy purely to teach people to find great deals that match the criteria already set out by the equity fund.
Shout out Ground Up Network.
So we're already starting phase one, and then we provide them a really good when they bring the deal in. Step two, oversight and validation. We have in-house filtering with from deals, and then if that person keeps bringing in deals that aren't good enough and they keep failing viability, they get referred back to training and be like, look, you're not ready, you're not doing this properly. You need more training. But assuming it gets passed, we have an employer's agent cost consulting firm that obviously we either have an interest in or that we really trust. They act as both cost, they do cost plan, they do the EA, and they also do the PMing through the build to make sure that every deal has to be main contracted out to a reputable contractor. So an inexperienced developer isn't delivering. So that developer is basically getting mentored through. So they'll have a minority position in the deal because of that on their first deal. And then the more deals they do, they can build up their equity. Step three, then, which I just talked about, is obviously getting that deal over the line and getting it funded. The equity fund obviously comes in on approved deals, which gets approved. Like you said, as Jack said, there's someone managing it, but there obviously is an approval process of it. And then yeah, it goes live. We couple it with debt funding, which obviously they are out there. But if it's past all those and we're putting the equity in, that should be okay. Like I said, first time the equity fund actually has a majority position for that level of risk with all the stuff. But then as that student does more deals, then it goes through. If an experienced developer also comes in because he'll be open to that, then great. They can jump straight into a majority position if it's proven. But the same strategy applies. EA needs to be involved, etc., etc. And there you go. For obviously to set the company up like that, you'd need obviously the core founder, manager, director, or team of them, and then you'd need somebody overseeing uh, marketing, as you said, bringing the leads in, and you need somebody overseeing the training. You need somebody overseeing the delivery side, and you'd need somebody either doing whether it's admin stuff, analysts, collating the appraisals or putting them together into approved board packs. And obviously you'd need somebody to be investor relations, managing the fund, and then some back office support, admin, finance, rest of marketing, all that sort of stuff.
So I think in terms of like the skill sets required, right? I think we've got everything you need, from being able to train people, being able to understand what's a good deal, what's not a good deal, the marketing angle, the administration, all that kind of stuff is pretty straightforward. And we already, between our skill sets, box that off. I think the one thing we don't have, that we understand in concept but haven't done necessarily in practice, is the credit side and understanding that sort of fund structure, top down, risk, mandates, those sorts of things. Investor relations, even we've got that on lock as well. I don't think that would be an issue. I think it's just would you agree with that? It's just the credit side that we don't necessarily.
Yeah, I would say it's the gap between us as developers and the source of money. The source of money is going to depict what you can do with it, and that's going to be the criteria that we have to meet.
What kind of mandate do you think it would be?
I mean, all of the other stuff. So loan to value stipulations. There's other stipulations.
Without jumping in, Jack, sorry, I think the source of funds is so important because I've met, and obviously Jack, you have to admit, and you too, Ryan. I've met like an individual, for example, who was extremely wealthy, an ultra high net worth individual, and just in through conversations, you can see that their criteria may be very specific or also maybe very loose. It's just like they're expecting this kind of like return, or they'll want to fund it on a deal by deal basis. And if that obviously opens a different set of risk. And then the more professionalized you come with a larger funding line, more institutionalized, you have the criteria you're talking about that definitely comes in to be the traditional deal criteria. Your loan to GDV exposure, loan to cost exposure, obviously the developer's experience. They may flat right refuse to fund anything with developers that haven't done anything before. Just all that, the criteria that comes in has to be passed through, has to be stepped down.
I was just going to say there's obviously preferences, and some of them are for an example, I know lenders that won't lend on commercial conversions because they don't like the product that's being produced. I know lenders that would only do ground up and not conversions. I know lenders that will be open to all. I know lenders that will be open to mixed use. I also know lenders who won't lend in the social housing space because of the potential of them repossessing the building and having to get vacant possession doesn't bode well for their exposure of the fund. The ultimate funder is then caught in that sort of publicity. So really navigating what that credit line are proposing that you can do. And then there is occasions, obviously, you're looking for a ticket where you can understand, the road goes this way and the white lines are here. But there is sometimes we need to stop, go and check and confirm that they're happy with a particular deal that you're getting over the line. And that's where discretionary capital comes within the fund. So if you roll profits yourself, you can then go, actually, I'm happy to take the punt on that and I'll sit in first loss. So the fund can actually go, let's use some of our profits to fund that deal at that leverage, but we'll charge for it because we're happy to take the risk over the credit lines facility. What we call it.
Ground up fund, baby.
Ground up capital.
Ground up capital. Oh, it'll be sick. I do think it's an inevitable trajectory for all of us, just because we're going to keep scaling and we're going to keep racing to the bottom of what's the easiest and cheapest way to raise capital. That's basically all we all do every year. We get better and better at doing that.
I think I've got a founding investor that would put 500,000 in for it, but I think in terms of to start it up though, you need to start it up with. I mean, I don't think for an equity fund you'd need to start it in the millions, like tens of millions. Sorry, you'd need to be in the early millions. I would say. I don't know if you guys agree or disagree with that.
I've had a conversation with a wealthy individual about this concept. I always prospect people on ground up. I'm always prospecting because it's the best product that we've been involved with. I'm like, we've got this thing, yeah, and there's 4 of us. We operate nationally all over the corners of the country. We have slightly different strategies, but ultimately we're all asset backed by property. Blah 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 blah. We want to set up a fund or a bridging structure, something like that, where we can deploy capital and it's kind of securitized across our experience, our network, the teams we've already built, all those things that scream risk to an investor. We've kind of boxed all those off with proven track record. Would you, Mr. Investor? He's ex. I probably shouldn't say where he is, but I can tell you guys after. But basically, worked in a very good position, built a £100 million company, exited that, and is now working with PE. And I had them both up, and 2 guys who did the same thing together, and just talking to them about the concepts. And to them, it's way more interesting to invest in an equity fund than to invest deal by deal. They were like, "Oh, I'd be way more interested in that than like here's a commercial residential project. You want to put in £500,000, and then the rigmarole of doing that." They would much rather sit in a position where they accept a slightly lower rate of return, and have a diversification across a load of schemes backed by operators who have a proven track record. So honestly, I think the concept is easy to sell. It's just having the business plan and the clear distribution of capital and how we could scale that up, how we could exit the early investors as well. That was a big thing they said is, obviously it's going to get to a point where it would be beyond their means of contribution. So what's the exit for them? Having all of that clear as day, and then just starting with warm connections who would put in maybe $1 million each, and we start with a 5 million, 7 million pot, and then we know that the next benchmark is to get someone who could put in 10 mil, buy them out, next person, and obviously abiding by regulation, because it starts to become a bit of a syndicate, and it's understanding that regulation and all those things. But I think the concept is quite easy, and I don't think we'd struggle to sit down in front of different investors and go, tell me this isn't a no-brainer. There's a good upside here, and it's securitized against property assets by good operators.
All comes back down to the money, as usual.
Yeah.
And anybody listening now, you just got the behind the scenes of a very hypothetical analysis of a business proposition. And
the typical growth of a lending entity is so I'm referencing a bank that we work with quite a lot. I call them a bank, but they're a debt lender. Here comes the dog. And they essentially set up because the guy ran a successful business, sold his business, and sold the real estate that was within the business company, and had a few tens of million quid. And then he decided to set up his own bridging company. He set up his own bridging company, and I love working with them. Very pragmatic, very understanding. Credit and origination was really straightforward. They understood who I was. They saw the whites of my eyes. They really backed my business, and we became their second biggest borrower for the first 5 years of their growth and the first 5 years of Central Suites' growth. We're doing deal after deal after deal with them, and I love working with them. They since got bigger. And this is at the point where you're talking about, like, where does the original investors exit and what is the purpose of us setting this up? We're not just setting this up for fun. We're setting this up because it's a pain in the ass working with debt lenders or equity lenders. So the principle of us setting it up is to get more control. We do that. We grow our business and it grows and everyone loves it and it's a really good product and we're growing, and investors are happy because they can see the growth, and we're happy because we can essentially use some of the homegrown goods and run our own businesses with a little bit more control of debt or equity lending across that platform. Then we get to a point where we get like a 40-50 million pound book, and we go to someone like a Shawbrook or a credit line and go, we want a 50 million pound facility. Here's all the loans that we've done. Here's all the succession rates that we've got back. Here's all the repayment dates. Here's all the returns. This is how we've operated the business. They go, cool, like it. As soon as you sign that paperwork, it's now not the same business and you haven't got the same control. You're not the puppet master anymore. You're being controlled by the funds that have come in, and that's probably at the point of exit. And then you're back into the same position where you're now working with the same as someone else in the market. And this is exactly what happened with this lender, that I can't get any favors produced, and it kind of doesn't really matter what we've done before. The principle of it is they do what they do because they've now got a credit line that comes in and they're being controlled by that credit line. They now don't have the autonomy that they originally had. And now that will be the point to exit. And now there's just a debt lender in the market or an equity lender in the market that does what it does, and you've exited. So that the interesting part for me would be the growth and the exit, rather than, great, you can borrow money off a facility while you're growing because it does serve a purpose. But I kind of feel that you get to a point where you go, it's not our business anymore. It's someone else's, and they're the same as everyone else.
Yeah, I think that depends if you need credit line from a bank, or if you can keep it more private, more with individuals. Because you could still scale with individuals. Just the proof of concept would have to really be there, and they'd have to have the risk appetite for it. But I don't think you need to go to a Shawbrook at 50 mil. You probably would at maybe 500 mil. You could probably keep it. Do you not think you could keep it private for a given period of time? And also, why scale it so big? Is there not a size where you go, yeah, pretty comfortable with that size in terms of just making absolute sums of money?
I think that on it's different. So I don't know if this guy had an equity fund, Jack, or a debt fund, but obviously on a debt fund that makes complete sense. The difference an equity fund has is it like, if you do it right, if it works, and you need a little bit of luck as well, and obviously we're good place because of our expertise too. Yeah, yeah. You can genuinely get exponential, as Jack was referring to, returns and growth from an equity stake, an equity play. Obviously, that's where you'll lose. That's where you lose your shirt, or you'll make the gains. It's not as stable as debt. So if it goes well, for example, um, you wouldn't necessarily, obviously, up to the founders, you could easily just choose, depending on the capital, to either obviously reinvest the profits made, and they could be actually quite substantial. Or at that stage, your money wouldn't really be coming from a Shawbrook for an equity slice. It would actually be coming from something like um like, again, like a family office or a private equity. Is more of a private equity play, and or it could even come from a different part of the market. So the mentality for the money, but you're right. Whatever terms you sign, you're into, like any business now, any business, any debt terms. It's all down to negotiation. It's all down to the terms you sign. And ultimately, if we were strong enough and it was good enough, you just wouldn't sign terms if if you didn't have the flexibility. You'd only ever do that if you genuinely needed the money or you were going to go under. And at that point, anyway, yeah, you should be considering that's more of a restructure of the plan to get the liquidity in, to change the structure, to get yourself weaned out for an exit. But if it goes well, you'd only ever bring in growth minus capital.
And you could still have, kind of like public companies, where you could still have, buybacks and clawing back equity and retaining ownership levels and things like that. And I think at that point, we just want to know, what is the size of an equity fund that makes sense? Like, what would be that size where you don't need to keep introducing new capital because the growth of the equity fund and being able to claw back equity in the fund itself and paying off investors, accepting you don't take your own skin in the or your own stake in the meantime, just to regain a majority position, kind of like how public companies work, if they're making good returns. Because we're probably talking about the difference here of a debt facility that might make 14, 12%, 15% IRR compared to an equity fund that might make what would you expect, 25, 30%?
Yeah, I mean, an equity fund's cost of capital will be coming in between 10 and 15%, and then the op cost overheads will take their 10 or 15% up to probably 20% hurdle that they'll be needing to hit to break even. And then beyond that, they'll probably set a hurdle. A fair hurdle is probably 20 to 25% IRR, and then a hurdle of whatever profit share they want to dictate beyond that. And it's typically 60-40 in the lender's favor, depending on how much the developer puts down.
When I think of an equity, because obviously this is going to be leveraged as well. So, but the return on capital should be annualized. Return on capital should be no less than 30%, but ideally the target would be way higher than that.
Interestingly, just one thing I find absolutely crazy with debt lenders is development lenders and bridging lenders are absolutely, in my opinion, having it off. They do all this talk in the market of 70% loan to cost, or 80% loan to cost, or 85% loan cost. But if you think about it, if you go into a deal with a debt lender for a development deal, and you need to borrow, like, let's say for an example, £1.5 million, that £1.5 million, they'll add the retained interest on. They will also take your build contingency as factored in. So let's say that's 10% of build. And they will then deduct their loan to value ratio. So actually the money out the door typically is under 50% loan to value, even though it's headlined at like 70% loan to value, which then obviously brings the equity piece down lower for an equity lender. So I think if you built a relationship with a debt lender that is very rigid on their underwriting structures, you can actually offload quite a lot of underwriting to the debt lenders. Also get deal drive, so you'll get deals that come to you because they're already going to the debt lender and they're coming to you potentially for the equity. So I do think that there is a way that you might be able to plug into the legals, the processing, the underwriting of a debt lender, which might be quite an efficient way to consider it if you went for a good debt lender, because you're probably sat 50 to 70% LTV, and then developer puts in the last slither of the stack, and you're off. So typically, if we've ever looked at mezz, I will always say I'll only ever work with a mezz lender that works behind the debt lender's legals, valuation, monitoring, etc. Because otherwise, you're just scaling out massive costs on the project.
We could be like the Y Combinator of property
I thought
development.
he was going to say the Wild West.
The Wild West.
Well,
I agree, though, like an
that's-
incubator.
I live in the Wild West. You know, I've lived in the Wild West for the past decade and a bit, so it doesn't scare me.
I think that's a good analogy, though. Like a Y Combinator and incubator for developers and for our own funds. I think that's interesting. But there you go. For our listeners, we started this podcast with going down one way, and then Dorian chucks a piece at us, and our brains start rattling, and we're an hour in suddenly. So we'll move on to the next bit, which we did promise at the last episode and the start of this one, which is if you are starting out, and not even starting out, you might have a well-established business and want to get into property, or you might be, a good high earner, or you're working, a working professional, and you've got a good job and it pays well, and you don't necessarily need to leave, but you might just want to. You might want to set up a business, you might want to set up a property development business, and we're going to try and give you the sort of 101 of things you got to look out for, things you need to have in place, the basic stuff, as well as then sort of forecasting and thinking of a growth trajectory. Dorian, do you want to start us off here, mate?
Yeah, sure. And just before I do, that's the whole point of starting this podcast, is for us guys to obviously catch up, talk business, and also share with relevant people also interested. So, give us feedback on our business idea. You guys are best placed. We've gone into in detail. Why don't you just send us, whether you're in the Ground Up Network, put it in there, or drop us a line. Ryan, does he explain best place to do that? But just say, are we hitting the nail on the head there? Is there even a problem? Is there not a problem? If there was, what would you? Have we missed something? You know, you tell us.
And if you've got 10 million quid and you want to put it into an equity fund with us,
Yeah,
we're open to it.
and that, yeah, definitely. Yeah.
I suppose we'll have to take that off your hands.
Fine. As long as you
I
subscribe.
suppose.
Yeah,
Yeah.
yeah. Now, Ryan, what was the other question?
um, so you're starting out. You want to get into property. You want to start a business in property. We'll say in property. And you want to become a developer. You want to own property. You want to own sites, and you want to scale that. And you're starting out. But you have. Let's say they have a basic understanding of property. It's just getting that inertia initially to get going.
But so so right, let me just rephrase this. So they have a basic understanding of property already, but they're currently employed and they want to get a business or get into property. What would I do if I was in that
The
position?
only reason I'm saying that is because before, when we've answered this, we've said, you should put money into training and learning the basics first before you. But let's say they've done that, they now want to get started. They want to get going, get boots off the ground.
So yeah, and I've said this before, and I'll say this again. I think there's two main things anybody should do when first starting is building up your level of knowledge and building up your network. Just rinse and repeat on those two things, and you do knowledge by online stuff like this, and books and whatever. Just learn as much theoretical knowledge about property investment, the sector in general, and then network by going to relevant networking events, as on just Google property investment networking events, and you'll find them, or obviously joining communities like Ground Up Network. And doing the rinsing and repeating those two things long enough will genuinely, I've put money on it, present the third invisible thing, which is the opportunities. If you rinse those two things, opportunities will come up. But if you're in a job and you want to get into property, the one thing I would highly recommend is and now this becomes situational, so I'm going to jump all over the place here. But first thing, I would look to scale a business that I have a skill set in. It sounds obvious, doesn't it? But for example, if I was in a work, like a manual working type of job, like a carpenter or electrician or plumbing, I would look to start some form of cash flow business alongside that. If I was employed now, and let's just say I was restricted with time and stuff, I would look to set a business up in that space that could cash flow, and like, whether finding deals for other investors, doing the refurbishment for them, getting a sourcing fee, getting a project management fee, getting the build contract, building up cash flows, and then starting doing my own projects. And I would focus on doing investments that high cash flow in the first place, so I could build up enough cash flow to recover my costs, and then I could have a choice of either scaling that business still if it's going well, or pivoting now that I've got a base cash flow that covers all of my overheads and everything else, and disposable, and I can go into something else like development if I wanted to. If I was in a job though that was like a professional white collar job, and it actually gave me a lot of time still, I wouldn't rush to leave that job. That's in that position. Let's just say I'm an accountant, for example, but I'm a work from home accountant, and as long as I do my work, then I won't get fired. I'm not recommending people to not work if you're in a job here, but let's just say your hours can be flexible. As long as I can do networking events and viewings and stuff during the day, I have no reason now to quit my job. So I would look to, again, start building my knowledge, building my network, find investors, and I would look to start doing property investment deals, provided I have enough knowledge, whilst I'm still employed. And I'd build up a portfolio again. Though the same principle applies. I would still build up a portfolio of cash flowing assets to cover my base costs before I go out and do what I really want to do. But the underlying thing, sorry to go on, I'm going to finish on now. The underlying thing about it all is really, what do you want? So for me, rightly or wrongly, screw loose or screw tightened, I want to dominate the world. I want to be the best of what I do. I want to scale a highly impactful company regionally, then nationally, and then eventually globally. I've always been like that. I've always said it, even when we started the show. That's just who I am. So for me, I'm looking to build a company that I can have the greatest impact in and make it as large as possible. Hence why I'm doing what I'm doing. But others will have a different target. If their target is just to get to £10,000 a month so then they can live off that and then go on holidays every month, that's absolutely fine. But I've rambled, but does that give you an answer?
Yeah, I think that's really important, mate. The start question is, why do you want to do it? Like, what's the goal? Because if you're in your 50s and you're looking to build up a retirement pot and you feel like property is a good way to do it, then you're gonna have a whole different perspective than Dorian. And the advice of building a team, infrastructure, those sorts of things, they're not going to be relevant to you. You might just want to stay and keep everything third party. And except you're going to get lower margins, lower rates of return. Depends if you're starting with capital yourself or if you need to raise that capital. So there's a caveat for a litany of different things that will depict what way you go from the start, depending on what your goals are. So, and that's easy to miss as well, because I think people don't think enough about that when they get into property. They don't think about what is my actual goal, and how do I stay focused on that goal, rather than I'm learning a new industry, I'm going to try all these different things, that some of which won't actually help me get to my goal. And you see people go down rabbit holes and distractions and all those sorts of things, and it's like, well, why are you doing that? Didn't you want to generate income? But now you're doing some kind of land deal, or you're doing some kind of commercial project that you don't know anything about. So having a clear goal and sticking to that goal is definitely the right way to sort of frame this. Jack, what would you say, sort of adding on to what Dorian said?
Yeah, so I actually asked ChatGPT, I said to ChatGPT, can you give me a random person's job role so I can think of a creative side hustle for them? And it coincidentally said a primary school teacher. And I thought it would be good to actually give a valid example of like ideas and transitioning it out of whoever it is being a teacher. Dorian absolutely hit the nail on the head with the why. If you don't actually want it, you're not going to stick to it, and you're going to end up still being a teacher in a few years. And I think that's a really, really important part that he's touched on. Typically, people want to go into a side hustle for a number of reasons. Flexibility in their life, the monetary return, or achievement. So that might be because they enjoy something, or if you're weird like Dorian, you just want to actually have the achievement of, scaling that worldwide business. I've actually got a really cool example of a friend's mum who did a bit of a side hustle, and I want to share that story at the end of this piece. So, I mean, the way that I would start is I'm going to sort of say generalized, and then I'm going to go into using an example for the primary school teacher. So I like to think about, where do you create value in the market space? That could be anything. Where do you know something where you can acquire it at X and get rid of it at Y, and that arbitrage in value is where you're creating value in the market. That could be a service, that could be a product, that could be a skill, that could be knowledge, that could be anything. So as a primary school teacher, that might be selling secondhand books, or that might be advising on Instagram and school platforms of what books your kids need to read. You could potentially actually build an Instagram page of how parents pre-qualify what primary schools their kids should go to, and watch your videos to understand how they get the best foot in the best door, to be in a catchment for the area of the schools and to onboard the areas of the schools. So your clientele in that particular respect is parents. And then you can sell products beyond that. So you might be able to upsell them to, I don't know, buy a bag or whatever it may be. So products led off the back of a service led environment, which I think is really important. And I think that'll be really attractive for parents to be watching that. And the beauty of a primary school teacher is the consumer is obviously the child, and the customer is the parent, and the parent tends to spend good money after good art for children. It's like almost like dogs, they spend ridiculous money on dogs. So find an area in the market space where you can add value, and then I would lean in digitalize, AI, tech, and scale is a pure focus. So try not to be paid for your time, and try to be paid for things that you can capture and indefinitely grow. That looks really good, Dorian, that ice cream.
My son just came and delivered it to me. Thank you.
I'm sure it should be the other way around in this relationship, that you're giving your son an ice
Orange trained him well, mate. Trained him well.
Yeah. Well done, Dorian. You've been to Sports Direct and picked out your favourite top.
You got a flake as well.
No, this is lovely.
So yeah, I'd focus on businesses that are digitalized, AI, tech, and scale, and not being paid for your time. And then do not discount partnering with other people or other businesses, so that you can get better scale exposure and compounding value, within another space. So for example, digitalizing and scaling is, you might then, if you do have an Instagram channel or a school channel where you're educating or even doing tuition, you bring people in to do the tuition for you, and you get paid their hourly rate, and you take a clip of their income as well. So rather than actually doing the work, you just facilitate a platform where maybe tutors come in and do extracurricular tutoring, and you're then managing that process outside of the actual school, but you're kind of maybe recording syllabuses that you're already doing in school. So it's just double purposing the same thing you're already doing, but making it more valuable. And then I'd just go on to say, once you then start to build a cash flow business, and I think some of the best businesses in the UK are sort of 200 to 5 million turnover, and I think they're some of the highest margin businesses. And I think that they're sometimes the best business to be run as a family entity to produce that flexibility, cash flow, and achievement. The difficulty part is when you go beyond 5 mil, you really need to then start building middle management, and businesses get a lot bigger, and it takes a lot more work and stress, and might take 10 years to get to that goal. Whereas a 200k to £5 million business can be easily managed, high margin, do huge benefits for favors for families, i.e., you can often employ a lot of the family in the business and make it quite tax efficient.
Sorry, Jack, that's really important, because when I was doing this, putting this pack together for this fund, I was looking at our past performance as well, and our overheads are high for our revenue. We have an overhead to revenue target of 5%. And in some of the scaling years, like 2023, 24, our overheads are reaching like double digits. And it's purely because of that forward investment and growth to blow past, and I mean this respectfully, 5 million to get to 50 million. I had to get middle management in, had to go through lots of different staff members to do that properly. And speaking to the fund, they understand that because they're involved in growth companies. But if I look at like the top line revenue of a turnover for one of those years, if I just take that year standalone and be like, if that was a stable year, I calculated that my overheads for the past 3 years, if I wasn't growing the rate I was, it's going to sound high, would be between £2.5 to £3 million lower. In terms of my net position, would be between £2 and £3 million better off. Obviously, though, I wouldn't have had. That's if I'm at where I'm at now, and stabilized. Does that make sense? That's purely because of the growth. So
And then going into sort of closing it off, really, building a business where you bring someone in operationally to manage it. And, for an example, Ben's architectural practice is exactly the perfect example. It's a 7-year-old company. He's got a managing director in that manages the ops. Ben's not actually an architect. He's an architectural engineer. So it's kind of like he's brought in the people that do the day-to-day running. He's just done everything else: the sales, marketing, operations, finance, and the talent. And now he's out of that business, and it's £1 million turnover, probably hitting anywhere between 10 and 20% margin, depending on growth. But it's a pretty consistent business, and he's out of it. He could work 3 hours a week in that and be completely out of that business as a single owned business. Obviously, he's very entrepreneurial, so he wants to do other things and grow other businesses. But if that was his sole focus, that business would be doing absolute wonders for his growth and his family and getting out of the day job. And then it gives you the ability to be like, right, quit my job. Now I can go full time into being an entrepreneur and going into other things. And when you create that and cash flow business, I would then say that's a good opportunity to then start to think about, rather than being an entrepreneur, start thinking about being an investing entrepreneur. Where do you put that capital to work, and where does that grow and scale from the spin-off capital that you're making from the origination business? But I mean, fundamentally, you need to work out of hours. You need to be putting in the shift. You need to be, once you come back from school, putting in a few hours. Once you do over the week, I think it's an absolute hack to be working over the weekend, because the crazy thing is, we've got a surveyor that works for us on Saturdays. So he goes to sites on Saturdays, and we try and get him out the door as much as possible on Saturdays, because every competition that we have only does 5 days a week, and our overheads monthly are the same if we have him go out every Saturday. So it's an absolute hack to be working in that time threshold of weekends and evenings, and you got to do it. And I feel that's just part of the hustle. And if you're not willing to do that, then maybe get back to the why do you want it. So as an example, a friend of mine, and I don't know if he listens to this, but he won't mind anyway. He's half Chinese. Tony, his name is. When he was born, his mum couldn't work. His mum couldn't leave the house. She was like babysitting for him as a baby. And she started basically making the duck roll pancakes that go into like Chinese restaurants. And he was telling me that she make thousands a day just because she was around the house and Tony was there, and that was just something that she could do at home. And she thought creatively. She thought, what could I do to make money? And she was making thousands of these things. And I think she made tens of thousands of pounds that year while she couldn't leave the house, baking these, creating these duck pancakes. And that is just an example of being creative, getting off your ass, doing something that's saleable in the market space. She's obviously, where can she create value in the market? She knows how to produce them. She knows the people that buy them. Boom, done. Client's happy. A bigger chain. The only problem I see with that business is it is not scalable. She's being paid for her time, until she gets maybe a bigger operation where she's managing the people that are making them. But that's an opportunity with it. It was only like a year period.
Get
where
Tony
she built-
making them.
I'm pretty sure I've seen photos where he's like rolling out.
Yeah.
and stuff.
It's all about
Um,
scalable
but
operation, right?
I just love that concept. Just creativity and a bit of hard work goes a long way, and that's and he's a really hard worker and he runs his own business. I kind of feel like if maybe she didn't do that, would he be where he is, and would he respect that as a business owner?
I think environment is so important. I remember, obviously my dad's very hard working, my mum was too, and they both struggled with dyslexia and obviously not finishing school. And even aside from the property stuff that they was doing, and inadvertently, my mum was no, I remember growing up. My mum was doing like stuff on the Avon catalogs and was selling like network marketing, selling stuff. People come around the hours and buying products that she's bought off, and just making cake or just stuff like that, really. So I think it gets drilled into you. Like you've obviously, Jack, been brought from a very hard working household as well. It's probably one of the reasons why you're such a hard worker. And I don't know what happened to you, Ryan. I'm joking. I'm joking. I know your dad I know your dad watches this, but your dad was really hard work, wasn't he? And obviously also very ambitious and was scaling big operations. So you got to witness that growing up. And if you notice, the three of us, environment does help you, doesn't it? Like, well, it doesn't help, but like it does impact you.
If I break down my week, I think I don't think that I don't think about work that much because it's all I think about. So I'm not like which is, I think, for normal people, they think about work and it turns off at 5:30, and then they'll think about it again at 9 the next day. All of us are predisposed to just never have that part of the brain turn off. So if I look at my week, I see the missus once or twice a month. So I've not seen her for over 3 weeks now. And up here, I've deliberately not built friendship groups here other than people we work with. So whenever I'm with the people we work with, who are my friends and family, we're talking about work and doing work. And I don't really do anything recreational, and I don't go to many networking events or anything like that. I'm just grinding all the time. And it's just a predisposition from the band days. Like in the band, I just grinded all the time, didn't see family, didn't see friends. So I'm like wired to just always work and just always do it and love doing it. And I wouldn't stop, and I wouldn't want to do recreational stuff instead of work until I have kids. In my head, I go, when I have kids, I'm gonna have to learn to do both and learn to like live a bit more of a life. But I think if you're building something, you just kid yourself if you think you can have a work-life balance, especially in a competitive market and a difficult market like property. You just got to be obsessed.
Look at that there now with mine, and I know I don't portray to be the best dad in the world, but I do try to balance doing stuff with them. Like yesterday, I was at my kid's football tournament, and then following that, I took him to taekwondo, and I did taekwondo with him, and we went to like an exhibition. And now today, and obviously, but before that, in the morning, I was working. I was up at 6 a.m. yesterday working. He was downstairs on his game. And so he's seen that. And now today, Sunday, I'm working on the laptop now. I'm on a podcast with you guys, and he's come in and he's giving me an ice cream. So he's picking up that I'm working and I'm still able to do stuff with him. So it is trying to balance it, but
It's never going to be perfect, is it? And I think just to help with the to give another sort of example. So Jack gave a really great example there of someone who wants to exit, build up your own security with your own kind of new business that can replace the day job, and then look at building up a savings pot and investment capital to go into property. I'll just give you an example from my own experience, which I think is going to be quite similar to all of us here, and is what probably most of our listeners are starting out on that journey on, or already well into that journey. And that's that initially, our first project, we put our own money in, and we'd saved money from doing other things over time. We wanted to get into property. So we went, all right, well, we'll prove the concept that we can actually do one first and put our own money into it. And that's me and my dad, and many people out there, many people listening to this, between yourself, your parents, your brothers and sisters, your uncles and aunts, your best mate, colleague at work, your friends, you will be able to raise money, and you should put. I think you should put skin in the game as well initially. If you've not got a proven track record, you should have skin in the game because it will make you a dog to make sure you don't lose money. Um, and get the bark away and get the first fucking project done. And that should be something simple. It should be a little buy to let, a little flip, something straightforward where you can manage the downside if something goes wrong, and you can inject capital if the forecasts don't pan out the way that you wanted them to, which will happen to you almost definitely on the first few projects you do. And that's how you get started, build up that, and that's how you get the inertia. But the caveat I would say is document everything. Film the whole thing, record it, get photos, before and after photos. Think laterally about how you could document this process as a case study to then go and raise more investment later. And then your stake starts to dwindle. And eventually you don't need to put capital in because you can provide a consistent service that gets returns for investors, and you can still take a slice of the pie. And that's kind of the road you got to go on. But I think you have to do the first few projects with your skin in the game. If you don't have any skin, make some money, listen to what Jack's just said, or save up money in your day job so that you can put, even if it's 20 grand, just 20 grand into the first project. And if you're at our sort of age, if you're like heading to your 30s and you've not managed to save up 20 grand by this point, then you're doing something wrong already. And you've got to learn to live more frugally and build up a savings pot so you can invest and do other things. So I'd say that's the first starting point. And then you've got to learn how to raise money and find sites and delegate and build up a word that Jack fucking hates, build up a power team, build up a resource network of people who you can go to for solicitors, architects, contractors, all those sorts of things, and be focused. Just focus on an area, focus on getting to know that area, focus on a strategy, and get really good at delivering that strategy before diversifying. The one thing I hate is seeing people like do a HMO as their first fucking project or something, and then doing a land deal. I'm just like, what are you doing? There's no real transferable skills there. Like, do another HMO or do something that's more in line with what you've already got some experience in. Get really good at delivering that, then start to pivot strategy. I think we've all seen many people do that, and it always bites me in the ass, and you'll always fuck it up because you can't know everything. It's too much in property to know. Two different strategies are like two different business models. You can't just do another one because it says property. They're going to have completely different ops. So yeah, that's what I would say. We're at the 120 mark, which is decent duration for our pods. And let us know feedback, guys, on how you're thinking of the pods. We're trying to think about what we're going to do this year and how we're going to take these pods going forwards, and introduce some more guest speakers and stuff like that, which we really want to do, and get some more business owners on here, some more developers on here. If you could think of anyone that you would love to see us kind of bring on, question about their journey, their business, all that kind of stuff, then drop them down in the comments or reach out to us and let us know who they are. And we'll try to get some more people on so we can hash out these kind of conversations. But if you're enjoying them, subscribe. We release these podcasts every Thursday at 5:30 a.m. on Spotify and YouTube. I know some people have been asking about Apple Music as well. And we will do that at some point, or Apple Podcasts. But for now, if you've got Apple and you can't listen to it, then listen to it on YouTube. Helps us and our algorithms anyway. So big love, and see you next week.
Ground up sound.